G'day. Welcome to another episode of Stock Talk. This is episode 36, and my name is Aman. I'm an investment coach here at Sage Investors. Thought I'd do a little something different today. Such a nice day outside. I thought I'd hang out outside and talk a little bit about stocks. Today I want to talk a little bit about something that kind of went on while this Brexit stuff was going on, especially the day after the vote, that really got a little bit of play in the media, but really didn't get as much as I thought about it. And the more I think about it, the more I got really concerned about it. And it involves basically a robo-advisor called Betterment Investors, one of the bigger robo-advisor firms in the U.S. On the day after the Brexit vote, they basically made a decision to, in the morning of the day after the vote, they made a decision to essentially halt trading, basically suspend kind of transactions. And basically, if you're an investor, you had your money with them, you couldn't get access to your money for a few hours that morning. And one of the reasons they cited for it was that the market was really volatile, a lot of uncertainty was going on, and they made a call, and they said, it was in terms of it was in the best interest of our long-term investors that they made the decision to hold off trading and hold off transactions on it. So a few things really jumped to mind on it because I thought it was a huge thing. And the first thing, the whole concept of it was the volatility aspect of it. As much as there was a lot of uncertainty and nervousness and angst going on during the market went down like 2-3%. It went down like 600 points, and the financial media was calling it a crash. Well, it wasn't even hardly close to a crash. When we want to talk about a crash, you're talking about like a 20% drop. So like in 1987 on Black Monday, when Dow Jones went down 20% or 22%, that's a crash. All the events in 1929 when the stock market blew up in 1929, that's a crash. When a market goes down like 500, 600 points, that's just like indigestion. It's just bad indigestion. So the fact that they have reacted to make such a really dramatic move to halt transactions on a couple of percent drop in the market is really kind of concerning, and it just fails to amaze me that somebody would actually do that. The second thing that jumps out at me is that's the whole concept of what the role of an investment advisory firm is doing. They're basically, as investors, we outsource our decision making and investment decision making to various companies who have more experience in making investment decisions. The basic tenet that keeps that relationship going is the stewardship relationship. So a lot of these companies, when we give money to a financial company, they are acting as our stewards of capital to manage our money. But the one tenet that's critical is that if we want our money back, we get our money back, no questions asked. There isn't this, you might want to hold off kind of thing and kind of stalling kind of tactic. And to me, that just really scares me because that should never be the case. Like if I want my money back on something, and if you want your money back on that's in a bank or something, you should be able to get it. Because if you don't, it creates that uncertainty and it creates that angst. It's like, okay, what's going on? Is the company going under? Is this going to be a run on the bank? Are they going to go bankrupt or something? It just creates that uncertainty, and to me, that was just not cool. Now, whether that was an actual good decision of whether you should get your money out of it during a market pullback or during a market correction, a stock market pulling back, that's a totally different discussion, and we can have a totally different discussion on whether the pros and cons of doing that. But the fact of the matter is, the investors should always have the option to get their money back, to pull their money out, no matter what the situation. And I found that really kind of concerning. The second thing I found also was the communication, that this whole decision to hold back trading was really communicated ahead of time to the advisors, from what I understand, who have an advisory relationship with Betterment. But retail investors didn't know anything about it, and they just found out it probably from Twitter or social media or just watching on TV or something. And that to me is not cool either. And it's just all about transparency. Like a lot of the business models of these financial robo-advisors is about transparency, being open with it. And the fact that they weren't consistently transparent with all these different stakeholders and their client base is not cool again. So to me, I just a lot of these things really left a bad taste in my mouth, and I have a feeling that companies like Betterment and to other robo-advisors' credit, they didn't cave into this, and it was kind of interesting to see, because it was one of the things I've been looking for, is to see how these kind of companies would behave in a market pullback. And really to the credit of with the exception of Betterment's decision, most of the robo-advisors really did a pretty spot-on job. They kind of kept things cool. They didn't like rush to judgment on anything. They kind of let the market play out, which is the way it's supposed to work. You don't like institute controls on things like that. That's just not cool. So, you know, I give credit to the robo-advisors, with the exception of Betterment, on how they reacted to it. The other thing I find really interesting about this story is that, ironically, this is, you know, done by a company whose investment decisions are based on algorithms and financial models and computers and everything. And ultimately, it was like a human judgment. It seems like, ironically, led to make that decision, and it's just funny on so many levels. So it's just something that really, I'm surprised it hasn't got enough play in the financial media, and I haven't seen much talk about this. And this is kind of to me, it's a serious thing. It's something I really want to keep an eye on, worth keeping an eye out, and especially if you're considering putting your money into a robo-advisor, you really need to understand what the rules of engagement are with them and ask questions in terms of, okay, if the market pulls back, are you going to cut off trading? Am I going to cut off access to my funds? What are you going to do? Like, what are the rules of engagements for me to access back my money, my hard-earned money that I'm working for? So, something I want to share with you. I hope you keep it in mind if you're out there looking for a robo-advisor service. That's something to keep out looking in mind, and we'll see what happens. So if you have any questions, feel free to hit me through Twitter. You can direct message me on @SageInvestors, or you can hit me through my website, www.sageinvestors.ca, and we'll meet up. And if you have any questions, if you want me to talk about a specific topic here on Stock Talk, I'll be more than happy to do that. So I'm going to go back to enjoying this wonderful day we have here in lovely old Toronto, and we'll catch you again. My name is Aman of Sage Investors, and we'll catch you again another time. Cheers.